Welcome to Don't Short Yourself Live. I'm Andrew Keshner, a reporter at MarketWatch, where I cover taxes. 2026 is not just any tax season, it's the first year with a new set of rules after President Donald Trump's major tax law. We're going to explain what all this means for you and answer your questions. Joining me today is Beth Pinsker. She's a columnist at MarketWatch and a certified financial planner. Welcome, Beth.
Nice to be here, Andy.
So here we are, deep in the heart of tax season, many new provisions to use.
Yep.
This law is so large. Let's start with the big picture here. Just set the scene for us on what the law keeps in place, what is new, and for the new additions, how long they're here for.
Yeah, so many of the new provisions come with complicated rules about who qualifies. So if you're on the low end of the income spectrum or the really high end of the income spectrum, your taxes might not be that much different from last year's or the few years before. But if you're somewhere in the middle, it's going to depend on what category you fall into. And the big ones of groups that are changing this year are homeowners. Mostly because the mortgage interest deduction has gone up so much. Seniors 65 and over are the next big group because there's an additional senior bonus deduction of $6,000 per individual, which has qualifying rules. And those who have overtime and tip pay, and they have to figure out whether they qualify.
The mortgage, you mean actually the state and local tax deduction?
State and local tax deduction,
Yeah.
yes.
I mean, again, there's just so many things that we're all trying to get our hands around. And to that point, I mean, so many people submitted questions ahead of time, curious about what it all means, and thank you all.
So many questions.
Thank you very much for that. And we will be taking questions live later on, so put on your thinking caps on that. But
See if you can stump us.
Let's start with Joseph, who asked about the law's benefits for workers. And actually, maybe I'll start with this one.
Okay.
He wants to know what this means for workers. And I think one of the most, the clearest examples are the new tax breaks if you have tips and if you have overtime. You've probably heard of this as no tax on tips, no tax on overtime. Well, not really. It's not really a no tax. It's a deduction, and a deduction reduces your taxable income. It's not a credit that would cut your tax liability. It's not an exclusion that just puts it out of bounds. But let's start with tips. This is one that lets you claim up to $25,000 in tipped pay and deduct that from your taxable income. And the overtime deduction lets you deduct $12,500 if you're an individual, $25,000 if you are married couple, but there's fine print, and we will get into that.
It's a lot of numbers to keep track of.
Right. And to that point, Adam also got specific on this. He was asking, what does it mean for workers who are earning between $100,000 and $300,000?
Yeah, because it's not just about how much money that you made in tips or overtime, it's how much money you made altogether.
Right. And that is a kind of rule of thumb throughout all of these new breaks and provisions. There are so many income phase outs and caps because they are trying to put in so many things into this law and contain it and target it that these phase outs really matter. And so for tips and overtime, if you're going to take these tax breaks, it's up to $150,000 modified adjusted gross income. We can explain that later, and $300,000 for a married couple to get the full amount, and then it starts to phase out from there. But so to this point, I mean, say more on this, because this is something that Steve was asking us about. What does it actually mean to have no tax on overtime, and can any job title have no tax on overtime, and what does it mean for my state returns?
Right, so if you look at the form where you have to put all this information, the word qualified shows up 12 times. Anytime you see the word qualified on a tax form, it means that you have to go look up the rules to see if they apply to you. And for tips and overtime, The tips for the first thing you have to look up is whether you have a qualified profession. So not all professions, like your job can't decide suddenly that your whole income is tip income and try to get you out of paying tax on it. It has to be one of the ones on the official list. And then you get down to how much of that income qualifies. I was doing a return, I'm a volunteer tax preparer, and I was doing a return for a man who had overtime pay. But only the part of overtime so overtime is usually time and a half, but only the half part is qualified. So that's the qualified part. So this man's employer hadn't broken it down for him. So we had to put it into a worksheet and figure out which part. We basically had to divide by 3. And that third part was the part that we could claim. And then it turned out that his overall income was below the standard deduction, so he wasn't going to pay tax anyway. So he didn't actually benefit from the application of this new tax deduction.
Bummer.
Yeah.
But one more thing before we move on, because Steve is bringing up this other really interesting point about state income taxes. And that is actually going to be kind of the next chapter in this tax law, because now we have the federal income tax code, that's all set, but it's what our state tax codes are. How much are they going to follow the rules of the federal system? And we just have to wait to see how that goes. Another topic we got a lot of questions on was the senior bonus.
Yes, this is a big one.
Yes, and it is sometimes called the no tax on Social Security. And that includes, so Antoinette had a question for us asking about the basics on the rules and eligibility. And so break it down for us on what this tax break is doing and what it is not doing.
Right, so when you go to file your taxes, the no tax, there will be the same way you filed your Social Security tax, your Social Security income and the tax deducted from it is going to be exactly the same. The senior bonus deduction has nothing to do with the line items for Social Security income. So where this comes into play is if you are 65 or over and you make within a certain parameter, so for a single person, that's $75,000. Under $75,000, you'll get the full amount, which is $6,000 per person. If you make more than that, you will start to see a phase out, and that phase out goes to $175,000. So in the 12% bracket, which a lot of seniors are when they're just getting Social Security income and maybe like a small pension, that $6,000 deduction off your income turns out to be about $720 less in taxes that you will pay on that particular line item. Now there might be, your income might have gone up for the year, so your overall tax burden might have been higher this year than last year. It'll depend on what the rest of your taxes are, whether you make out plus or minus for the whole year.
So just sticking on that point for a second, Robert also asked this question: what are the key tax rule changes impacting retired couples? So you're starting to hit on it, but take it.
So basically, when you talk about filing single, it's one set of numbers, and when you talk about filing married, filing jointly, it's another set of numbers. These numbers work out pretty easily to just double. So if one person gets $6,000, if you have a married filing jointly, you get $12,000, and then the income distributions also then double. And the tax bracket information then also goes up, not exactly double. So you have to figure that out as a couple and what your strategic use of any extra money that you're going to not have to pay the government this year. You might want to do a Roth conversion. There might be other things that you can use that money for other than putting it straight in your pocket.
Yeah. So still sticking on the big picture here, we got a lot of questions on the law's implications for the economy and different segments of the nation. And James, for example, wanted to know what would the impact be for lower income households and for upper income households and for the economy as a whole. And I mean, honestly, we could spend a whole 30 minutes, 30 days, 30 months. I mean, this is the debate that will continue, and I think
this is what we talk about at the water cooler every day.
Right, yeah. And so it's two it's too soon, I think, to say definitively, but it is interesting to note there's a lot for everyone in this law because it is very big, and you have these tax breaks that are some that are geared at working class households, like tips, overtime. Then you have others that may benefit more on your upper end, like the state and local tax deduction, which is quadrupled in size. And then you have the estate tax, which it was going to go lower, and then the law prevented it from falling lower. And so it is the first $15 million of an estate is free of estate tax. So again, you see that wide sweep. And so, but I think to shift gears a bit, we were talking about the rules and what it means on paper. But again, here we are in tax season, and I think it's like, now show me the money.
Right.
Like, let's see what does this mean for me and my tax return? And a lot of people are expecting larger refunds as a result of what's happening here. So
yeah, there's been a lot of buzz about that.
Yeah, and so you mentioned you volunteer in tax preparation and doing your own taxes. I mean, what are you seeing so far?
Well, I think the one thing I want to remind people is that getting a bigger refund is not the same as paying less tax. What you really want to hear from your tax preparer or the tax software is that you owe less tax. And when I'm doing returns for people as a volunteer, the program is set up to help lower income people. So they are, for the most part, just having the same normal taxes that they had last year. For me, the big change in my personal taxes is that one of my kids aged out of the child tax credit, which this year will be $2,200. Now it's only going to be $500 per kid. And so that's a tax. I actually will probably end up paying more tax. And I'm most of the way through my taxes. I just haven't signed the form and sent it in yet.
So I know you said refunds, that's not, it's, don't get too excited about it. I mean, but let's face it, people love their refund, and it is honestly like the single largest payment that some people get all year. So, I mean, it does matter economically. And so far, some of the numbers are showing that refunds are actually up. I want to say the average is about, almost, it is like up to $2,500 roughly at this point, mid-month of February compared to the same point last year. And so it is up, and where that ends up remains to be seen. But a different question is something that Alan had about how is the IRS doing okay? Is it going to handle all of all the new laws, all the new questions, because the backstory for them is that their headcount has been severely depleted over the past year. So, I mean, what are you hearing? What are you seeing? Or are we all still holding our breath?
Well, most of the operations are automated. So if you don't have any questions or any problems, and you just hit the return, send return button, most of it is going to happen automatically, and you don't have to worry about the staffing. But you've also been hearing things about, longer response times and things like that. So.
I mean, I think the one takeaway, without getting too nerdy on, like IRS hold lines and this and that is this is definitely a year you want to check once, check twice, check 3 times, make sure everything is accurate. You don't want any sort of hold up or snag that is going to get things, raise a flag with the IRS, because it's just going to take longer to resolve that.
Absolutely.
So, and also file electronically, direct deposit, and so on. So there you go. So, and now thinking back to the long term, planning opportunities. We have all these changes, all these ways that people can make the best of these changes for themselves, because it's also in this short window that a lot of these are here.
Yeah.
Most of these new tax breaks are here through 2028, and so this is a time to make the best of it. So, for example, we get a lot of things about Roth IRAs and Roth conversions.
Yes.
And for example, Ron asked, what are any of the talk about Roth conversion strategies in this new tax environment, and also just, I guess, remind us, what is a Roth IRA to begin with?
Yeah, so remember that $720 I was talking about, that if you got the $6,000, the full $6,000 senior bonus, it would turn out to be, $720, probably less taxes you would have to pay. If you don't need that $720 immediately, like to pay bills or get out of debt, you might want to consider something like a Roth conversion, and that is taking money out of a traditional IRA or 401k where the money is pre-tax. You've put it in there and you haven't paid tax on it yet. You want to get it out of there, you have to pay tax on it as income. So you could take an equivalent amount of income out of that account, say $6,000, and move it over into a Roth IRA where it will grow without ever having to pay tax on it ever again. And that $720 can go to pay the tax on that additional income. And so this is what people are talking about when it's a Roth conversion opportunity. Whatever they're getting in the senior bonus, whatever lowering they're doing of their taxable income, they can take money out of their pre-tax accounts and convert it into Roth without taking money out of their pockets. It will come from their tax savings.
Yeah.
So it's just a different application of the money. It's not like money coming out of nowhere or free money. It's just that's what you're spending the money on.
Before we go on to more strategies, I just want to remind people, if you have questions, feel free to throw them at us. We will take as many as we can at the end. And back to strategies here. So another one, I feel like we'd be remiss if we didn't go through all this and talk about the strategies from SALT, SALT deduction.
That's going to be a huge one.
And Laura, this was something Laura asked us about. Just help us understand this. What are the basics on this? So, I wrote a couple stories on this. So I want to set the scene. This is a provision. You can use it to deduct your state income taxes, your local property taxes going
and
up,
your
up,
mortgage
up.
interest.
Oh, well, yeah. There's that too, yeah. And so it used to be $10,000. Now it's $40,000 for 2025 returns. And the people who can take it are individuals and married couples that make up to $500,000, and then there's a phase out. So it sounds great, but there's a couple boxes you have to check. Box number one, you have to itemize to take this. So that means all of your potentially itemizable deductions, SALT, mortgage interest deduction, charity, and so on, it has to outweigh what you could get on the standard deduction, which is also getting bigger. So
most people haven't itemized in years.
Right, exactly. So number one, can you make more? Is there more you can deduct going the itemized route? Box one. Number two, and actually, there's going to be a lot of people who are going to do this. There may be 5 to 7 million people more who are going to itemize to take the SALT deduction, and it could be real savings, according to some estimates, like saving $1,200 in tax savings, avoided tax for families between $200,000 and $500,000, according to the Tax Policy Center, and these are people in like the marginal tax rate of like 24% to 32%. A lot of that. That's great. But box two is do you live in a place where you can deduct these taxes? Do you have high property taxes? Do you have
New York, California, New Jersey, all those places? So
it's going to depend on those. It's going to depend on those things as well. And one strategy I've heard is bunching charitable deductions, charitable contributions. So Milko had asked about this, about the estate and inheritance taxes, and are there any changes to look for? And my answer to that is that most people are not going to hit that $15 million estate tax limit where that starts to kick in, and you have to think about giving a charity to get that money out of your estate. But if you are going to itemize this year, charitable deductions, charitable contributions can count towards that itemization deduction, and it can take money off of your adjusted gross income. So
if you are going to give, you might want to put all of that money together into 1 year so it has the most impact. And that's what bunching is called. It means that instead of giving $5,000 3 years in a row, you give $15,000 in 1 year. And it just makes it more effective from a tax perspective. The organizations still get the same amount of money at the end of the day, and you've still contributed to charity, but it just has made a bigger impact on your tax bottom line.
So let's shift gears a second from what has changed in the law to how people are navigating the law. And in this day and age of AI, a lot of people are turning to, you name the tool of you like, and they're using it to figure out taxes. And maybe that's a good thing, maybe that's a bad thing. And we are figuring that out right now. For example, so Jack asked, what is the smart way to use AI, and can it truly help? So
you've had a lot of good suggestions on this. I mean, I think it's February, and you need real answers at this point. So but maybe you needed to estimate for next year. But you tried this out.
Yeah, I wrote a story on this, and I talked to people who were using AI, and it really kind of boiled down to 3 things. And actually, before I even go there, full disclaimer: no one I talked to said feed your stuff to ChatGPT or Perplexity or whatever, and send it to the IRS and hope for the best. No one said that. It's more about using it as your sidekick, your super smart Dr. Spock sidekick,
right,
who is going to help you. And so 3 different ways. Number 1 is to educate you on what a certain deduction means and if you can use it and if it makes sense. Another one would be getting yourself organized to say, oh, well, I'm going to need this piece of paper, that piece of paper, and these records in order to take full advantage. And the third one, with a little bit of a slippery slope, but is planning. Using it to think about how much should I be paying in tax on estimated taxes, or how much could I possibly be withholding and not get dinged by the IRS. So that brings me to a point from Patricia, who asked, what are the specific AI tools that may help with a decision like the size of a Roth conversion?
Right, and I think that for that, when I think about that, it's to know really what you should do for that circumstance, like a Roth conversion. You need to have real numbers. You can't get a general answer from that because it won't do you any good. And so, you're much better off at that point going to a financial professional who can run the numbers for you, or going to software that's designed for that, which operates the same as AI, but within a closed system and specifically designed for that purpose. So I would, caution people to move more towards that kind of software level than just, saying, hey, my name's Joe and I make, $50,000. Should I do a Roth conversion?
Yeah.
You don't want to put any of your personal details in there.
That is a great point. And I see we're getting some live questions in, and thank you everyone for
so many live questions.
Yes.
Oh my goodness.
So, but before we get to those, just kind of to put a pin in it on smart ways to use AI. Jennifer was saying, you're talking about how we can use it, but what about AI hallucinating, and how do we know that it is doing the right thing or what? And I think it really comes back to, you've got to have a human, a true professional checking this, knowing what is happening. And so don't trust AI. AI doesn't get the last word on it. And so that was a takeaway from me. And what Jeff said got even more specific on this point. He was saying, how do you feel about feeding sensitive 1099 or W-2 data into a public AI tool? And my feeling is I would not do that. And if you want to run numbers and you can put in numbers, but you don't say, this is Andrew Keshner, here are my W-2s, here's my social security number, let's figure this thing out.
Yeah. Well, I was just scanning through the live questions, and Tony asks an AI question right off the bat. This is our very first question. Will AI eventually enable individuals to strategically set up holistic structures that, like, to run your whole life so that you're minimized in taxes? And my first caution on this would be AI tends to be not very great at consistently reading the years of things. So,
Right.
You're paying 2025 taxes now, and you're working on planning for 2026. Is your AI model going to differentiate between those two things? Because they're vastly different. And the numbers are all going to change. So if you're planning for 26 now, you have to make sure that it's not reading 2025 numbers or
Right.
2024 numbers.
Right.
And so I think you would have to do so much backstopping and checking that I'm not sure that you would want to go by the prompts that sets up for you without really knowing where the data came from.
Can I throw a Social Security
Yeah.
question at you? So
Sure.
Jason wanted to know about the phase out
Yes.
on the senior deduction. And so, it's all well and good if you're a married couple that is underneath that $150,000 mark, but what then? Like, talk about that phase out
This is where
afterward.
qualified comes back to
Yes.
get you. There will be a line that says, or the form itself. If you're doing it on paper, it's the easiest way to describe it, but nobody does it on paper anymore. So if you feed in your income as a couple into your tax software, or you give your data to your tax professional and they put it in their software, it's going to calculate automatically what your phase out is, because on the back end of the software, the fields that it needs are connected. So it will tell you, it will spit out a number that says this is your senior deduction based on what for this, it's your modified adjusted gross income, not your adjusted gross income. So it adds back certain things, which is like municipal bond interest, which doesn't always apply to everybody, but does apply to a lot of seniors.
Yeah.
So the form, if you're using software, it will tell you based on what income you have already inputted in other fields.
So we got a question, and it is about, are there changes for income from stocks? And it's really interesting that in such a huge tax law, there's actually very little that is changed on like capital gains or any of those things. I interviewed someone once and I asked her, like, what gives that? And the thinking is that, well, it will be good for investors if all of the tax provisions juice the economy in different ways. So, to be honest, correct me if I'm wrong, but I don't really think there is much that has changed for
Not much,
investors.
except just to point out to people, who are new to taxes or new to understanding some of this stuff, that there's one set of rules for income and there's another set of rules for capital gains. So your investment income plays by different numbers than your work income.
So back to because you are the master on retirement questions.
Yes.
How about an RMD question for you?
RMD question. Let's go.
Well, actually, first off, time out. What is an RMD? And then Gary wants to know if you get an RMD, a required minimum distribution, at the end of the year, do you still need to make quarterly estimated payments?
So RMDs are required minimum distributions. Those tax deferred accounts I was talking about earlier, the IRAs and the 401ks, where you put the money in there before paying taxes on it. Mm-hmm. When you reach a certain age, the government wants it cut. And they are very insistent about it. So for most people right now, that age is 73. For people my age, by the time I get to be that age, it's going to be 75. And you, because you're younger than me. But the government wants it to cut. There's a formula. You have to do it very precisely. You have to do it on time. And if you don't, you get hit with penalties that are pretty steep. And so the question is, what was the question again?
I guess, do you still have to make estimated payments?
Yes. So RMD withdrawals, when you take money out of those accounts, the tax is deemed as paid throughout the entire year. So this is why a lot of people, in fact, most people who are at the RMD phase of taking money out, take it out in December. They want to see what's happening with their income needs over the course of the year and what's happening with their accounts. And they take the money out in December typically. Some people take it out as a monthly draw, but a lot of people take it out in December, and the tax that you pay from that withdrawal is deemed as having been done throughout the whole year. You can pay it quarterly if you take the money out earlier, but you don't have to, as long as you pay the right amount at the end of the day.
Tathane, I'm going to take a stab at this, and then you can pipe in too. Tathane had a question: what strategies can a W-2 employee, essentially a wage worker, use to reduce their taxable amount, reduce their taxable income? I mean, this is like a perennial question that is super important,
Yes.
especially again at this time when we're trying to, maybe you're like really close to getting a tax break and you don't want to go over, and so. I mean, I think like the one of the easiest, straightforward ways is to put even more into your 401k.
Yes, but you have to do that by December 31st. So
Right.
it's too late for that one.
But I mean,
You can do it next year though.
okay. How about if in IRA, possibly, right?
If you qualify to if you have earned income and you want to make a pre-tax IRA contribution in a traditional IRA, you can do that by your tax deadline. So you still have that one on the table. Most people at this point, though, are putting money into their workplace 401ks, and if they're making a separate contribution, they want to make a Roth IRA contribution. And that you make after paying taxes, so it wouldn't reduce your taxable income.
Let's see. We got one question here is having to do, it's just, I guess, good sources on finding a CPA, just a good old reliable tax preparer.
Yes. So there are two kinds of people you want to look for when you get your taxes done. One choice is obviously a CPA. People know what that is, a certified public accountant. They have a certain amount of training. You know what the requirements are, you know that they're licensed, and you know that they have continuing education requirements. The other kind, which people know about less, is an enrolled agent.
Yeah.
And those are people who specialize in filing taxes and are certified by the IRS. They pass a test, they have continuing education requirements, and they are actually more trained on the mechanics of filing taxes than CPAs, who typically deal with businesses and bookkeeping and other things other than tax preparations. But be aware that anybody in the universe can tell you that they're a tax preparer and set out a shingle and do taxes. You don't have to be licensed in any way to call yourself a tax preparer. But I tell people to look for either a CPA or an EA, an enrolled agent. And I, get my own taxes done by an enrolled agent, because even though I'm a tax expert, I still get my taxes done by somebody else.
Was it like, the lawyer who represents himself as a fool for a client?
Yes.
Maybe the same thing goes for your taxes too?
Yes, it's also a time factor. My taxes are complicated, they take a lot of time, and I am more confident in my enrolled agent that they have kept up to date on the nitty gritty. I talk about the big picture, but they know all the rules.
So we had some other questions. I want to actually, I feel like we got to talk a second about crypto before we go here. This was a question that came in a little bit earlier, but it was from Gary, who wanted to know about cryptocurrency withdrawals and basically what is the 2025 tax status on crypto. The big thing this year is super nerdy, but it is called the 1099-DA.
Yeah.
This is a new piece of paper that your brokerage firm has to send you, the crypto investor, and the IRS, saying this is the amount of proceeds that this person got in a year, this year, and it could be from a sale, it could be from a coin swap, it could be that sort of thing. The key omission actually really is that these forms that are coming to you and to the IRS are not showing how much you paid for them at the start. They're not showing that, what the IRS calls the cost basis.
Right.
And that
the really big deal is that you have to know whether you had a gain that you have to pay taxes on or a loss, which you can use to offset gains.
Right. I mean, so, if you bought a piece of Bitcoin for $500.
Lucky you.
Right. And then, you sold it and you made a profit, great, but if you can't show that basis, the IRS will put it at 0 and then you're paying for the full amount.
Yes.
So I think one tip when talking to crypto tax experts this year that I've talked to, they've said just be ready to do that legwork to find how much you paid for your crypto in the beginning.
Yeah, and we had another question here from another reader who wanted to know whether it was better to go with an ETF than invest in crypto, which is a stock traded mutual, not a mutual fund, but like a mutual fund, but basically a product that you're buying and not the actual crypto, or is it better to go with the actual crypto? And in that sense, because of the record keeping, you're going to get a lot more record keeping from an ETF in terms of what your basis is of buying the ETF than you would the basis of self-custodied or even crypto that's custodied at an exchange, because they're going to give you more information.
A small business question for you.
Okay, I'll try.
Give it a shot.
This might be the one that stumps me, though.
All right, this is from Fred, who has a small business. Can he still make a 2025 SEP IRA contribution? And actually, what is this? What is a SEP? It's like a single employer?
So for small business owners, freelancers, gig economy workers, anybody who's got non-W-2 income, there are ways to save. This actually came up in the State of the Union address. That Trump was talking about trying to start a new program for workers who don't have access to a 401k. So there are several different ways to contribute. There's a SEP IRA, there's a simple, and then you can have a solo 401k, or you can just contribute into your Roth IRA or a traditional IRA. There's actually ones beyond this. There are cash balance pension plans that you can set up for yourself. Most of those deadlines to contribute are your tax deadline. And by your tax deadline, I'm specifically not saying April 15th, because sometimes the tax deadline is not April 15th. And sometimes your tax deadline is not April 15th. If your area had a natural disaster or has a weird holiday that's only in your state, sometimes your tax deadline is different than the national tax deadline. And sometimes you file an extension, and some of these can be extended, so if you to whatever your tax deadline is. For most of these, though, however, you need to set up the accounts by December 31st of the year that you want to contribute to. It's not exclusively that has to happen, but in a lot of them you want to check. So if you did not set up a SEP IRA, did not open the account by December 31st, you want to check with that custodian to make sure that the contributions that you make now would be counted. I had to go through this when I set mine up. I made sure I set my self funded account up by December 31st, but then I didn't fund it until like April. So you have a little wiggle room there. So I could answer it.
Bravo.
Yes.
One question here is about software packages and what's up with software this year. Most people use it. Is it still a good idea this year? And I can't sit here and say this one is great, this one is trash, and so on.
What's the alternative that they're proposing? Like, is the alternative paper, figuring it out on paper, or using software, or is the alternative software or go to a live person? Because that's the difference. Like, paper, no.
Right.
Like, nobody does it on paper anymore. Like, it's just really, why? Why would you do that? It's too hard. I use software as a volunteer tax preparer. I find it to be perfectly adequate. It gets the job done. Any professional you're going to go to also uses software. Their software is just better than the stuff you get on the open market. Yeah.
And I mean, for a lot of people, I think so many people's taxes are simple enough that it really, it can, the software can handle it. When I've written about, do I go to a professional or do it myself? I think the real value add, so to speak, is you're going to get the plan for especially complicated taxes. You're going to get that planning and that human touch, and that, like, well, maybe you want to consider this, that, and the other in the years to come. And you're not gonna get that with software. You're just gonna get, like, plug in those numbers, and you pay your bill, you get your refund.
Yes.
And
we should mention that there are still some free opportunities for free file, even though some of the government programs have gone away. The VITA program still offers free tax assistance. Most of the major tax software companies will do a free file for you if you have very simple taxes. Like my 2 kids are teenagers, and we file their taxes, me and them, because I make them sit there with me and do it. We file their taxes with the free file program because they have one little small tiny W-2, and that's it, and they qualify for that. So
we have a question on gold, precious
okay.
metals, and are profits from selling gold bullion taxable? If so, who reports it to the IRS, and what kind of paperwork is required?
The IRS wants their money for
yes,
everything.
Number one,
everything.
absolute gold, bring it on.
Prize winnings, lottery, gambling, government wants, like if the question is, does the government want? Yes.
So, but with gold, what's interesting is it's not your traditional capital gain stock market profit. It is a collectible, and so I'm a little bit stumped on the exact number on how high that it can get taxed at, but it gets taxed higher than your traditional long-term capital gain of 20%. And so that is, and it's not just if you have gold bullion and you're selling it, it's also if you have shares in a physically metal-backed, gold-backed ETF, that also counts in the eyes of the IRS as like a collectible. So yes, the answer is definitely the IRS considers that taxable.
And just like with crypto, your basis is going to be your true concern.
Yes, yes. Let's see. I think we're getting near the end here, and so we're going to end it up with one last question. This might stump you. This might be get ready for it. Mark wants to know, have you done your own taxes already?
Well, I think I've already said that I send my taxes out, and I have sent all of my material to my tax preparer, but I haven't signed the form and emailed it, e-filed it yet. But what about you?
I have not yet. I am still working on it. In fact, so Mark is reminding me I probably need to go and file my taxes, and so we'll have to wrap it there for now, Beth.
All right.
Thanks for joining us. Check out MarketWatch for more tax stories and subscribe to our new newsletter, Don't Short Yourself. Each week, we'll share our best money tips to help you grow yours. Until then, happy filing.